everyone to the Adjusted for Risk podcast here from the shores of Lake Tahoe. Well, it's that time of year again, and I'm not talking about holiday parties or holiday shopping or ugly sweaters. I'm talking about the 2023 investment outlooks. We're seeing them pop up for the past couple of months, actually. So it's my turn. So here is my 2023 investment outlook. Now, I'm not going to go through our throughout some predictions for where the S&P 500 is going to end the year, or what the 10-year treasury yield is going to be at the end of the year. But I will provide a few things to be aware of as we enter 2023, and what are some of the things that you should look for as we move into 2023. So let's start with arguably the biggest storyline for really the past couple of years, and that's the Fed. So let's start with the disconnect between the Federal Reserve and investors, which that disconnect has caused markets to sell off this week. And that disconnect between the Federal Reserve and investors will continue into 2023 and lead to more volatility. While the Fed this week downshifted its rate hikes from 75 basis points to 50 basis points, the tone of the announcement was still hawkish. Furthermore, the dot plot startled investors. The Fed is committed to taming inflation and doesn't believe that their job is close to being done. And that's evidenced by their higher for longer stance. So as a result, Fed officials are projecting rates will end 2023 at just above 5%, 5.1%, before dropping to 4.1% in 2024. Meanwhile, conversely, investors are forecasting something different, or shall we say hoping for something different. They're hoping for rate cuts in 2023, not additional rate hikes. Additionally, falling treasury yields are defying Fed actions as bond investors fear the Fed is going too far. The bond market is fearing that the Fed is raising interest rates too high, which is going to cause a recession. So investors, and that is seen in the recent fall of 10-year treasury yields down to below 3.5%. So investors are looking at that deep inverted yield curve, which is signaling pain ahead, while Fed officials, on the other hand, continue to signal that its fight against inflation is far from over with. And adding to this uncertainty is the fact that, back in September, there were 0 Fed officials predicting that rates would climb above 5%. That was just a few months ago. And now all of a sudden, 17 of the 19 Fed officials are predicting a 5.1% terminal rate by the end of 2023. So this changing narrative and views of the Fed is having a very negative impact on investors, and is going to moving forward. So that disconnect between investors wanting, expecting, hoping for a pause in rate hikes, or even yet a pivot to interest rate cuts, is completely different than what the Fed is signaling, that they're going to continue raising interest rates and keeping interest rates high throughout 2023. Second, the next one. So 2023, I believe, is going to be a comeback tour for the 60-40 portfolio. For the past couple of years, there's been all this talk that the 60-40 portfolio is dead. And a lot of that had to do with, interest rates at zero, right? Eventually, the interest rates couldn't go down any further. So eventually, the Fed was going to have to raise interest rates. And as we know, when interest rates go up, the bond prices fall. And that's what has happened, and there's other things that played there too. But, as interest rates have climbed. Bonds, the Barclays egg has experienced its largest drawdown ever. The Bloomberg Barclays egg is, experienced its largest drawdown ever. And that coincides with a bear market, nearly a bear market for US equities when they're down 15%. So when you consider bonds are in a largest drawdown ever, and you're looking at 15% down for US equities, that 60-40 portfolio isn't looking so hot. So after a period of rising correlations, which we've experienced in really 2021 through this year, look for correlations between stocks and bonds to normalize or fall as inflation falls in 2023. Now, 2022 was a very bad year for bonds, but there was a positive. It was much needed reset as yields climbed to relatively attractive levels. The softening inflation combined with tighter monetary conditions, it's going to help lower correlations between equities and bonds and bring relief to that 60-40 portfolio. Okay? The idea is with 60-40 portfolio is when, things are good in the equity market, equities rally, 60% of the market, 60% of your portfolio is going to capture that rise. But let's say equity markets falter. That 40% of the bond portfolio that's in bonds or fixed income is supposed to keep that portfolio afloat. Well, that hasn't happened because the correlations between equities and bonds have increased. Well, now when correlations decrease, the diversification of that portfolio increases. You can also add some alternatives there. And now all of a sudden, that portfolio is working again. So bonds will regain their role within the investment portfolio and really start to produce attractive total returns as yields stabilize and fall as we move through 2023. And we're going to talk more about bonds here in a little bit. So next, the battle between inflation and economic growth. So it's going to be a lot like a teeter-totter. And what falls first? Is it going to be inflation or economic growth that falls first? If inflation falls first, then we might experience a soft landing as it will allow the Fed to stop its rate hikes, or even better yet, start rate cuts sooner than planned, which will be a big boost to investor sentiment and equity performance. However, if inflation remains stubbornly high, the Fed will have to keep rates higher for longer, negatively impacting economic growth, which will fall first and result in a recession as the Fed continues with its high rates to try and tame inflation, which really at this point is the Fed's primary goal right now. So when you look at it, it's going to be inflation or growth, economic growth. And if inflation falls quickly, it's going to allow the Fed to slow its interest rate hikes, pause, or even cut interest rates. So if inflation falls very quickly, that's going to support and help economic growth from falling into a recession and maybe a soft landing. Conversely, if inflation does not fall quickly, economic growth will. Economic growth will fall first because the Fed is going to have to keep rates higher for longer to try and tame inflation. Fourth, so talking about a recession. I believe a mild recession is likely. It is often stated that you don't want to fight the Fed, and the Fed has made it very clear that more pain is ahead, and they have a lot more work to do to corral inflation. The more pain will be felt particularly in the labor market as the Fed tries to balance supply and demand of labor, which is going to slow wage growth to try and bring down inflation. We have started to see signs that the economy is slowing, whether that is in the housing market or in this week's poor retail sales number that signaled consumers are starting to pull back due to the high prices and less liquidity due to higher rates. So as I mentioned before, the Fed is hyper focused on bringing down inflation, and that means causing a recession. So be it. That's their goal. If a recession is a result of bringing down inflation, the Fed is ready to do it. So it's important to note that I think it will be a mild recession as the consumers and businesses alike still have solid balance sheets, which should help the economy from a deep plunge. It will keep the economy somewhat afloat. Yes, we're going to have a shallow recession, but it's not going to be a deep, long, real painful one. And a lot of that recession is going to be caused by the Fed tightening the purse strings, keeping liquidity low, and financial conditions tightening. Fifth, so I mentioned at the beginning that the disconnect between the Fed and investors is going to result in more equity volatility. Well, there's going to be other things at play here that's going to continue to contribute to equity volatility. Additionally, a slowdown in economic growth, soft earnings, tighter financial conditions will also result in more volatility. We are also looking at a potential earnings recession in 2023 as margins compress. That's going to hinder earnings further. And we cannot ignore the risks associated with geopolitics and the conflict between Ukraine and Russia. And I think that with the Fed and potential earnings, higher interest rates, inflation, unfortunately, that conflict between Ukraine and Russia has kind of been put on the back burner, but you cannot forget about that's going to continue to cause some volatility in 2023. Sixth, don't worry, we only have a couple more things to focus on. So we're almost through this. The volatility is going to provide opportunities and for investors with longer time horizons to take on risk, which will be rewarded down the road. There will be opportunities to buy growth at relatively attractive prices. Now, there will be some bumpy roads ahead, but if you can stomach that volatility, you'll be rewarded down the road due to being opportunistic and buying at attractive valuations. Now, it's not going to be for everyone because, like I said, it's going to be a bumpy ride. But if you can withstand that, if you can stomach the volatility, there's going to be opportunities for some attractive valuations, some strong returns or strong rewards down the road. Conversely, investors with a short time horizon should remain cautious. Focus on dividend-paying stocks and high-quality investments with 10-year Treasury yields at less than 3.5% again. High-yielding stocks start to look attractive again. There's beginning to be, remember Tina, there is no alternative. Well, there is still an alternative here. Yields at 3.5%. That's an alternative to equities. But if it keeps falling well below 3.5%, gets down to 3, those high yielding stocks begin to look very attractive again. Look for companies, sectors, industries that are more resilient to an economic slowdown, like consumer staples, healthcare. And if you're a really cautious investor, look to utilities. Again, high quality dividend paying stocks will help reduce portfolio volatility and increase downside protection for those investors that have a short time frame. Lastly, look for bond yields to moderate. We talked about bond yields earlier. Look for yields to moderate and eventually fall later in the year as the economy slows. Later in the year, I believe the Fed will begin to hint at potential rate cuts in 2024 due to the economic slowdown and hopefully cooling inflation. So the moderating bond yields will offer attractive total return opportunities. And while yields, even though they will come down and moderate, will still remain relatively attractive compared to the past 10 years when yields were zero. While the Fed, I think, is going to employ some rate cuts at the beginning of 2024, which is going to impact yields later this year, we're not going to see interest rates at zero, in 2024 or even 2025. So I think bond yields are going to still remain relatively attractive compared to what we've seen the past 10 years. As with equities, focus on high quality investment grade issues. Meanwhile, high yield bonds, they were much more attractive earlier in the year. Not as attractive now when you consider the risks due to an economic slowdown. High yield spreads, which currently sit at 4.37%, have narrowed over the past couple months. And that 4.3 credit spreads, that's not really that attractive at these levels when you consider credit risk that lies ahead due to tighter financial conditions and an economic slowdown. So while investment grade bonds are very attractive in a total return basis moving forward, and it'll help with providing some stability as the economy slows and with some volatility in the equity market, it's too early. In investment area and high yield bonds just aren't attractive at these levels yet. So lastly, or that was lastly, I'm going to finish with this. Most importantly, I think make sure your clients remain focused on that big picture. Really, while not losing sight of the forest through the trees. Stay the course that is mapped out in their investment policy statement or financial plan, because at the end of the day, achieving their financial goals is the most important objective for your clients. So there's going to be some bumpy roads, continue to stay the course. If you're invested, stay invested. If you have some cash on the sidelines, employ dollar cost averaging. You don't want to jump in all at once, kind of nibble back into markets. So with that, I would like to thank you all very much for listening or watching this edition of the Adjusted for Risk podcast. I hope you all have a great rest of your week and a very fruitful and successful 2023. A reminder, you can watch past episodes of the Adjusted for Risk podcast on our YouTube channel. That YouTube channel is Adjusted for Risk. Or listen to us on Spotify. You can also get more of our insights at our A Wealth of Insight from 6,237feet.com blog. So with that, thank you again very much for listening, and I hope you all have a great rest of your week.